Southern California's Filipino sari-sari store. And SoCal Filipinos presents Kababayan Korner. This week, let's talk about Tax Baby with special guest Jennifer J. Sato, CPA, MST. Please welcome your host, Abby Ronquillo and John Eric Pabalan.
Hey, good evening, everyone. Thank you to everyone watching and to the members of SoCal Filipinos and Southern California Sari Sari Store Facebook pages. Thank you so much for being here. Here in Kababayan Corner, what we are doing is showcasing our very talented Kababayans. So tonight, our main host is Abby Ronquillo, CEO and owner of Net Realty. And our special guest for tonight is Jennifer Soto, CPA, MST. How are you girls doing today?
Doing really good.
Busy.
Thank you so much for having me.
Yeah,
and my dog.
Yeah, thank you so much. And Abby, thank you for being our main host again.
Am I the main host? No.
Yes, you are.
Well, Jennifer, thank you so much for agreeing to meet with us today. I know that a lot of people, especially from SoCal Filipinos, there's a lot of things going around regarding Venmo payments, PayPal, and Zelle, and a lot of people have misinformation or about it. So maybe you and Eric can dispel that. And also, I have a lot of homeowners that are wondering, what can I write off? I'm a new homeowner now. What expenses can I write off as a new homeowner? So
Sure.
that'd be great if you guys can go over that today as well. So
Awesome.
Okay, so what we could do is maybe start on like schedule a Jan, like kind of like what we briefly.
Or Jennifer, can you tell us a little bit about
Oh
yourself?
yeah, you're right. So sorry about that.
Sure. Well, thanks for having me on. I guess more recently, a lot of different hats I play, but I have been a CPA for since 2009, I believe. So been in the practice for about a dozen years. It's exciting and not. And then more recently, prior to COVID hit, I also became a business owner or tried to launch my brand, and then of course the world decided to change. And so playing that aspect, the entrepreneurial aspect, on top of being a CPA, on top of also being a homeowner, as well as a potential landlord for my business rental, is all very relevant. And putting on that hat as a tax preparer is very important. So been slightly out of the tax preparation game throughout last year, but always picking it up as I do have many tax clients as well, and preparing for their returns. So the long and short, been practicing in this field for over 10 years.
Actually, Jen, I'm just curious, how did you become a CPA? What was your journey to becoming one?
Sure. So initially, I just took my strengths in high school, which was primarily math and science, and I went to UC Davis for 2 years to become a biomedical engineer. That was my initial major, and I kind of scratched out my love for science and picked up the math and just the business aspect of it. And I was very much a practical person. That was more like, let me find a practical job to fund the things that I love to do, which is primarily like art or expression, like creativity stuff. I was very much that type of person to find that practical job. And so going through that journey, took my strengths in that and went through the CPA route. It was very difficult. Don't get me wrong. I've failed on the exams multiple times. It's very discouraging. But at the same time, though, excluding the idea of CPA or a title to begin with, like these days, many people who understand financial or tax work, it's available to them. And it has been a journey. Don't get me wrong, to just pass those exams. But depending on where we are professionally, I'm sure we're all just working just as hard to prepare the communities that we're trying to be a part of. And yeah, when I went to my master's, I was working, I still am kind of working for the firm. My late managing partner, he passed away he passed away, and he sponsored me for me to be able to take my master's in taxation. because I very much want to dive into the realm of education and knowing more about tax work, because it's all relevant anyways. And hopefully being able to be in the realm of education and teaching even high school students, which that's something that should be a part of, high school or even elementary. I've been able to be a part of Cal CPA that does provide high school, financial preparation programs. So trying to dive into that was on my to-do, but many life happenings kind of impeded me, or but here we are being able to start it today. So thank you for allowing me to share this with you.
Yeah, thank you. Actually, I could relate to a lot of Jen's experience because both of her alma maters are also my alma maters, like high school, St. Jen, and then Cal State Northridge and CSUN. And on top of that, the struggle, I mean, the discipline actually needed just to take those CPA exams. And there's 4 of them. You have to time it. You gotta, it's pretty much just the whole discipline to finish everything. It took me took me 2 years to finish mine. But yeah, I know the struggle about that one and the fulfillment after completing it.
Absolutely.
Can you guys tell us how difficult is a CPA exam? Because I know there's tax preparers. There's from H&R Block. I mean, sometimes people use CPA and tax preparer interchangeably. So, what would you say is the biggest difference? And because I know the CPA exam is pretty tough. So, can you go over what you think or what the main differences are? And
sure. Yeah. You want to take that one, or
no? I'll let you take it.
Well, I mean, to me, I guess CPA versus a regular EA or tax preparer, of course, kind of dives into very similar tax prep work, but also the CPA provides more services, especially in like the accounting, the public accounting realm. If you want to sign off on particular financial statements, those are kind of required. It changes up the types of continuing education we need to as a CPA to do. Also, I guess it kind of depends on the kind of work you want to dive into. If you want to kind of stick with either bookkeeping or accounts receivable or accounts payable clerk within a company, it may not be necessary per se. This is my personal opinion, to need a CPA license if you're going to work within a company. Now, if you're trying to also be in the public accounting realm and actually working on, financials of other private companies, then potentially going that route could be suitable depending on your kind of goals to come up the ranks in the public accounting firm that you are working for, or even if you're working for yourself. I guess it's more kind of like a self-motivation type of thing.
Okay, thank you for that. What's funny? While me and Eric were talking, we found out that we both used to work at Deloitte and Touche. So speaking of public accounting, I did a little bit of public accounting myself. I used to be a paraprofessional, where you're billable. I think I was the lowest of the low in Deloitte and Touche. And Eric said that. What did you used to do there, Eric?
Oh, I did audit for Deloitte and Touche. So,
oh my gosh.
No, that's great.
Oh, yeah.
we were doing 60-70-hour weeks.
Yeah, that's ridiculous. I stuck with kind of like the small to medium boutique firms, because my thought process to understanding accounting and tax in all was to stick with the smaller, I wouldn't say small, but comfortable, 15 to 50, 100 people firm. So you're able to work through an umbrella of stuff instead of being a pigeonholed working on one particular thing. But that was my direction, and being able to work through a lot of umbrellas of different types of tax returns has been pretty meaningful. But yeah, diving into the pay scale is a different story, and that's kind of like, we can have drinks over that one. And that's almost why, when you're putting us all in an equal playing field, we're all working hard on particular things. And, even excluding the idea of just CPA, despite working hard for that education aspect of it, it's one of those things where just negotiation is a different play for that, on top of how we want to kind of come up in the ranks, if any, wherever you are practicing, I guess. As well as if you want to sign off on particular returns, There are just more things that a CPA might need to entail, but along with that comes those annual continuing education. That is not fun at all. So, yeah.
Sounds interesting and also very
Yeah.
complex being a CPA. So how did you guys want to start? So did you want to start as far as the tax returns? Did you want to start Schedule A or
Yeah,
how
I
are we
guess
gonna?
Schedule A, because the thing is for 2021, I'm sure you have assisted quite a bunch of people in obtaining their homes, right? So there's a lot of people that became homeowners last year. And I think, discussing what are the tax effects of home ownership is, I think would be a pretty good topic to roam into right now.
Sure.
I mean,
Okay.
that's
So,
why a lot of people become homeowners because they want to have that tax shelter and be able to write off the what can they so why don't you guys tell us like what can we write off as being a homeowner?
yeah,
Am I going to take this one?
yeah, I'm letting you take all of them.
Oh, all of it. Thank you. So, all right, I'm gonna put on many different hats here. So, as a homeowner, one of the particular important pieces of documents is that settlement statement. That's gonna say your purchase price, your property taxes, some of those, your closing costs, and all the commissions paid. Those are going to be relevant for your tax preparer to see what is either depreciable if, say, you want to place your home. So sorry, in the hat of being just a homeowner, primary residence,
Yeah.
I'm going to be able to deduct interest expense on the loan that you've paid throughout the year. So you have your form 1098 that's going to be given to you from your lender, as well as PMI, if that's going to be on that 1098, as well as your property taxes on there. That's going to be solely if you are just living there as a primary residence. You have no intention to either rent it out or create any type of profit. Those are going to be generally what you're going to be able to deduct on your Schedule A on your Form 1040 income tax return. Now, diving into the idea of potentially renting out a space, or you want to also, you're now put on the business owner hat. Hey, so now if I'm going to put on the business owner hat and I have, say, like 100 square foot and in 1,000 square foot home, okay, let's say maybe 10% of my home could be deductible because I'm using the business use of home on my return. Now you have a Schedule C business, or however we'd like to set up that, to be able to deduct other things, like almost like within the home, I gotta pay like either utilities on the home or rent, not the rent, excuse me, other repairs and
Maintenance?
maintenance. So those are going to be indirectly, and it'll be kind of like 10% of your home, just for example purposes. But that will take it out of your Schedule A, or it'll partially be Schedule A and partially on your Schedule C, or if you started your business, business use of home can be a deduction. But as we stick to Schedule A as a primary homeowner, those are the types of things that you kind of really care about. Now, the thing is with how 2021 and more previous years change is that standard deduction anyways is about 12 grand, or if you're single, and about 25 grand if you are married filing joint. And the long and short is if your interest and property taxes and say charitable contributions are gonna not exceed 12 grand, it's almost a moot point to even consider putting a Schedule A, because you'll already be
You already
given
have that
standard
deduction.
deduction.
And just to clarify, when you say Schedule A, you meaning itemized, right?
Yes, the itemized
Yes,
deduction.
when the itemized.
Yes. So, as tax for your tax return, you have the ability to either use a standard deduction of about 12 grand, or you can itemize your deductions, which will show on Schedule A. So you have those two things going on. But now I'm like, okay, well, crap. I don't see, because prior, being single would be 6 grand standard deduction and about 12 grand married filing joint. And so almost being able to itemize at that point has been more relevant to own a home, to be able to take the deduction on that interest. But now it's almost like being able, like, well, now my interest is wiped out. Is there any other benefit I'm able to do that? And that's almost where being able to rent out your space, if anything. But that's also just kind of including all that, in Schedule E or Schedule E rental or Schedule C business, or however you would utilize those homes. That's it.
That's why it's always good to be a business owner, right?
Sometimes.
And actually, like
with all the pains and sufferings, sure, it's worth it.
and also like a curveball. I mean, not really a curveball, but I guess also another topic of discussion for in relation to like what you can, about mortgage deduction of mortgage interest. Those that have done the mortgage forbearance, right? Since
yes.
When did that end? The mortgage forbearance, 2022, right? I'm sorry, 2021.
2021.
Who's
Forgive my
22?
dogs. Although there are still forbearance plans that are still able to, depending on your lender, if you're able to continuously extend it, that's still kind of going on. Yes.
Yeah. So just like a discussion is anyone that's on marriage forbearance technically are not paying any mortgage interest.
Correct.
Meaning if they had if previously they were deducting, for example, $20,000 of mortgage interest, suddenly
Right.
you're not deducting any of that this year.
Correct.
Because if you had the forbearance, then you wouldn't have that mortgage interest deduction. So that's also something that, besides from the homeowners, that's the homeowners that did the forbearance. Well, they can't deduct that because then you didn't pay for it, right?
Correct. They wouldn't be able to pay for it. And if anything, honestly, if your mortgage is going to be less than $800,000, I don't no, actually.
Depends on their interest.
You can only go to
it'll depend on their
right?
interest. And if you're in California and you got under 4% interest, and if you just meet that 12 to 15 grand, it could be worth it. But see, if you're also kind of already married, right? Married filing joint, you already have 25 grand. Are you going to really exceed that to be able to take the advantage of that 12 grand interest that you paid for that year? Probably not.
But then
unless you made a hefty contribution,
charitable contribution,
or your property taxes exceed 10,000, because you are able to property and also your income taxes from your W-2s are itemized deductible, or if perhaps your medical is a different topic. I don't want to really dive into that, but
no, that's too much calculations with the AGI.
too many things going on. One thing that I would like to share, though, is that, and this could be relevant to, say, the medical field purposes. For medical expenses, if you happen to exceed that threshold, you can deduct, all those PPE, everything kind of COVID related, a lot of those kinds of expenses, as well as, with those miscellaneous deductions greater than 2%, right? So federal, for the past 2 years, it has been excluded. However, for California, it is includable. So my thought process is, if you are the type to be able to itemize for this year, and you are in those fields, to be able to give them upkeep or your business licenses that can be under that 2% miscellaneous deduction, still give that to your tax preparer, because it will be excluded in federal, but then it'd be great to have an adjustment to your California, if you live in California, to be able to include that as additional itemized deductions. So see if that'll be relevant to you.
Yeah. And that's why I wanted to squeeze in earlier is, you may not need to itemize on your federal, but it's favorable to itemize on your state. So then you still get, your money back, or if it's if you're paying, at least it'll reduce whatever your tax liability is.
Yes, absolutely.
Mm-hmm. Yep. And then
so is that everything with Schedule A?
That's the gist of it. Yeah. And
summary.
That's a summary. Now it's kind of moving on to hey, now I'm a business owner, or hey, I'd like to actually rent out my space. Now it's almost moving some of those potential deductions onto that, if you decide to put on that type of hat. So I guess we can move on.
So how about as someone that owns investment property?
Sure. Um, and they wouldn't include it. So they would hold it for investment and they plan to rent it out, or do they want to use it as like a second primary residence? Or
No, as an investment property, is it different from Airbnb? Like if you have an investment property and then one that's like a rental, a tenant rents it out, and then the other one is an Airbnb. Like, are there different tax implications with
sure,
regards to
good,
that?
good question. Actually, hold on to that one. I wanted to scale back actually for Schedule A, again. So there's a cap for your interest deduction. So if you have a mortgage prior to December of 2017, you're grandfathered into the cap of $1 million to be able to deduct your full interest on that loan in full. No, sorry, I'm gonna reiterate that. Say my mortgage is 500,000, and at the end of 2021, my mortgage interest was about 15 grand. I meet one, I bought it before 2017, and therefore I'm not limited to like any cap and able to deduct my interest in full. Now, say in 2021 or 2020, I bought $1 million home, right? There's a cap of 750,000. The interest on 750,000 will be deductible, and the 250 is going to be wiped out. There's a particular calculation, but those are the things that, as you give that to your tax preparer, it'll show the balance of your principal payment, and it could be limited for the current year, or for those owned 2018 and onwards. But of course, that's something to talk to your tax preparer about. Coming back to kind of like Airbnb or rental, I think depending on, what do you call it, the intention of the homeowner, is one trying to stay in? I mean, are you trying to like live in it as well as share rental space with someone? Or
No, it's just a rental that someone's renting out, and they live in there.
oh, so yeah, so they do live there and they are renting out with them
Mhm.
or with potential tenants.
Yeah, it's just tenants renting it out.
Okay,
The homeowner's
so
not living, right?
Yeah, the homeowner's not living there.
is not living it. Okay, great.
Yeah.
So are we also kind of saying they bought it in 2021, or
We get really technical with
2016.
these questions when we do taxes. We have to ask all these
yeah?
questions.
So 2016, I'll just use
no,
us
no
for an
problem.
example.
Sure. So few things going on. Say I bought this home, right? I'm using it for primary residence, and now I'm ready to kind of like rent out particular space. I own this home under my personal name, and therefore I prop up a Schedule E on my personal income tax return, because I'm now being able, I wouldn't say like in the business of like, we can go passive losses, all that fun stuff, but if I generate rental income, say I made $12,000 in the year, like 1,000 for the year. Now I prop a Schedule E to show that 12,000 rental income. Now, say I made the interest expense, but I'm a standard deduction because I don't exceed that, but I have rented out a space. Now I can actually take a portion of those interest deductions and property taxes and deduct that on my Schedule E. And the thing is, as you own it personally, you will generate that Schedule E personally. Now, if you wanted to kind of create as an Airbnb, similarly, however, Airbnb, or if you do receive like a 1099, or however it's received, like they pay Airbnb and Airbnb, however that transaction comes. I personally have not. I do know certain colleagues who do deal with Airbnb. So, I mean, correct me if I'm wrong, but if you receive any type of 1099 and if it's issued under your personal name, then yes, it'll just be on Schedule E. Now, if you have the intention of creating an LLC to rent it out in full, like completely full Airbnb, or have buy a new home in 2021 or 2022 for investment property, sure, you deal with a 20% down, all that stuff. But it would be advisable to probably create an LLC for that, a partnership for that, instead of just a Schedule E, although it can go either way. Like you can still own a rental property under your personal name, like even if you want to go into partnership with anyone, go ahead, put it in the personal name.
But
This is
the
just kind of me chatting about it, but it would be
Is-
advisable if it is going to be investment property to go ahead, create an LLC and get all those deductions for it.
Is it better to have it in a LLC because you can have more write-offs? Is that the benefit?
Not particularly, although being able to, have that as a standalone, there and as an owner for that, there could be a lot more write-offs and things depreciable for it, even if there's going to be like improvements made on it or changing floorings and all that stuff relative to it. The tracking of it as a separate entity would be I guess easier to keep it as its own. But similarly, the thing is with that, you deal with, of course, the annual. If you live in California, you deal with your annual $800 tax. Now I have, and I currently I will share, since I do in our own home, being able to rent it out, I will continue to stay as a Schedule E, because one, I am the type, I'm like, okay, can I justifiably say, is this worth creating an LLC for and pay the $800, or can I just kind of like show my quick rent, take my deductions, take the loss, and justifiably so, show that on Schedule E. So you have that option. Like it's not really necessary per se, but depending on the intention of it, sometimes it would be preferred to just create an LLC for it.
Yeah, and especially if it's like an Airbnb, you have like different individuals that's gonna be showing up to your house, right? They'll be renting to your house. Of course, you want to protect your personal assets, but
Yes.
in terms of that case, I would definitely do an LLC.
Absolutely. Yeah, protecting your assets separate from that, because especially, and that's with any investment property, right? Say my tenant would be like, oh my gosh, I fell or something, and they want to sue you. It's very much like the protection of my LLC holds only this building and not any of my other real estate or my own home. Like they can just sue you for all you have if it's
Right,
not on the LLC, if that makes sense.
So we do have an investment property, but we make sure that we have extra insurance, like that added insurance to take care of any lawsuits, like
Okay.
personal liability or anything like that. Because I mean, I have my business in an LLC, but then I never thought about putting our investment property in an LLC until right now.
So I think especially, and this is kind of like also me personally as I personally think, especially for the first few, sorry if my dog is singing. If even for the first few years, there is, how do I say this? It's almost like for the first few years, I personally would be able to even consider keeping it on the Schedule E without creating an LLC for it. Now, if the intention for that is to, you'll get more tenants, or you might consider someone like you are scared of that type of liability, then later down the line, being able to generate an LLC for it would be advisable. And that's just my thought process.
Okay, makes sense.
Yeah, and that's similarly even for business owners, right? Now we're jumping into Schedule C. That's going to be for business owners, separate from renting. Similarly, 2021 or 2020, a lot of people open up their own businesses. That it wouldn't be really advisable per se to already open up a corporation for it, or an S corp, because it's like, okay, now I'm going to be subject to an $800 tax, or $800 fee. Instead, Schedule C is almost being able to do the same thing. It's just more like, what are you willing to show to the IRS on the face? So, but first 5 years of any business, anyways, is generally incurring a loss, anyways, for startups. And so, keeping a Schedule C or a Schedule E for sometimes the first few years should be fine. It's less accounting work per se, But it's also just like, what are you willing to kind of like show on the face of the return versus having a separate entity for which you're going to pay more accounting fees or tax prep fees to do. That's it.
Okay, so when you do a 1090, because I remember I have mine on Schedule K. Is that if you have a 1090? I mean, is that if you have an LLC, and then
Hold on.
sure.
Crazy boy.
I'm gonna turn on my lights too.
Let me just kind of like bring you over here with me with my crazy.
So her question was like, I guess you receive a 1099K for any revenue you've
Me?
got? Yeah, is that what you're saying?
No, I mean I have everything on a Schedule K, and then I have an LLC taxed as an S corp.
Right. Good. So good question. So you receive a Schedule K, a Schedule K1 from an S corp.
Yeah.
So the accounting work was already done for the S corp, right? And so they already incorporated, and you receive this particular because you invested in it or you are working through that. So that Schedule K is already given to you. That will still show up now on your Schedule E as an investment now. So you receive that paperwork, and that already flows to your individual return on your Schedule E.
Yes.
Yeah. But, and I'm sorry, your question for that again was?
I forgot what my question was.
No, I think you mentioned about your 1099K. I'm like, what I'm doing is.
Oh, no, not 1099K. I mean, yeah, I get a 1099 for certain deals, but I guess I was just wondering, like, what are the advantages of having a LLC taxed as an S corp?
LLC taxed as an S corp?
Because I know there's different ones that you can do, right? If you have an LLC, you can just have it like a straight LLC or just like under an individual. Like for me, what I've seen is that I can write off a lot of stuff. Like if I make a certain amount, like I can write off certain things. Like for instance, like an app. The app that we created.
Absolutely. So similarly, so even if you decided to do an LLC or an S corp, or even if you put it on a Schedule C, it's almost going to be the same kind of deductions. It's just kind of depending on the intention of the owner, of course, dealing with just the liabilities of your assets. So let me actually go somewhere else.
I love dogs. By the way. You have 8 dogs, so I totally understand.
Do I want to actually go in here? Probably not. I don't even know who's So, write offable things. And what's kind of showing on the face of your return, right? You receive that K1, you have one line item. What passes through to you, like your net income, say, is $100. Versus a Schedule C, you'll show your income of about 50 grand, and your deductions are, 40 grand, $500, and you got that $500 net income. That's going to show they're going to see that all on that Schedule C. So exposing that to the IRS, that's what you're going to show. Versus you receive your K1, and you only see that one line item of $500 going to Schedule E. So I wouldn't say that's particularly overlooked by the IRS, but it's more of like what's going to be on the presentation of your return. Either way, if those type of expenses are justifiably so, you can go either way. There are particular taxes to self-employment tax that passes through to you anyway, whether or not you will work on through the Schedule, C as a business owner or those Schedule Ks.
Yeah, I want to bring up, we got a question from Lopez Fambam, Tony Rose. She said, we may be adding a TIC in one of our properties. How should we file? What's TIC?
Tenants in common. Sorry, say that one more time.
She's asking, we may be adding a TIC on one of our properties. How should we file?
A tenants in common.
So pretty much it's like renting a space.
Yes, it's almost like renting a space. So similarly, if you do own it individually, I would still suggest currently just to keep it on your Schedule E and create that. I wouldn't really suggest needing to do any type of LLC for that separately. If there are any types of insurance to hold that, I would still keep it individually. Yeah. I do know particular people too owning, Vegas properties or out of state properties, but still here and similarly still just kind of reporting Schedule E's.
Yep,
So,
same.
yeah. I think it's almost just also your risk tolerance, really. Is it worth paying like that $800 to put it in an LLC? Or, if not, then E would be fine too.
Yep. And then we got another question. It says here, please I think they meant talk about the 1099s to be issued by Venmo or Zelle.
Sure. So all of those issued to that coming back to Schedule C, I am a business owner. I received all this. I started my business. I received this 1099K. If those also included payments from, say, personal people, they will. I'm pretty sure. I believe they will show all of what's received, if it's going to be for whether or not it's business or personal. It'd be up to that the taxpayer to kind of itemize. Well, I actually received, if my 1099K say was $1,000, but 400 of that was actually like reimbursements from friends for meals, then technically I'm only kind of taxable for $600, right? But I have to. IRS does the matching principle. I still need to show that $1,000 as a business income, and almost be able to put down like, no, this was a reimbursement, and therefore I would create a Schedule C and deduct, the $400. And also relative to anything generated for that $600, say, you can write off, your bank charges. I need to use my phone, telephone expenses, relative business expenses. You can write off part of your home. You can write off, say, those monthly fees for, depending on your line of work, what is relative to you. You use your car a lot, so business use mileage. Parking fees, your travel, if it's also applicable, office expenses. I needed to use my computer. I bought a new computer this year. Now,
a new iPhone 13.
We can dive into like many different strategies too. And I'm gonna be, how do I say this? I'm going to be safe with how I chat about that stuff here.
Yeah.
But the long and short is almost like things that are relative for your business is write-offable. So even if you generated $600, but hey, you know what? I needed to buy a MacBook Pro. I needed to, build my website that cost me about like $1,000 already, but I wasn't able to use it. I'm still being able to write off like a website expense. Say I did bring many people to lunch, like to talk about like this business plan, or work with them, or create general business relationships, network things. It's like advertising, marketing, promotional type of expenses.
Yeah.
Could be relative to you trying to generate that $600 that was part of that $1,000 1099K issue.
Like, how did you generate that? Yep.
And though, so it's almost being able to wipe it out. Now, I'm sure a lot of people are probably concerned with, well, can I take a loss? Like, say I have $1,000, but I actually have like $6,000 worth of stuff. Oh my gosh, I have a $5,000 loss now. Is that kind of red flaggable type of thing? I get that a lot sometimes too. So, and it's almost like the long and short is, one, I'm a startup. It's almost expected to have a loss anyway. For even the first 3 to 5 years. If it's up, then great. 2, I wouldn't need to potentially incorporate. That's going to be another one. And 3, IRS paper trail really only kind of cares about what's reportable. So you receive that 1099K, you got to show it as other income, or whether or not it's really self-employment income. You got to show it and back out what is not reportable, really.
Yeah. And in terms of expenses, the key word is ordinary and necessary, right?
Oh yeah. As long as those expenses are ordinary, necessary, and reasonable.
And reasonable, yeah.
And R, yes. Or let's just say RON for short.
Yeah.
RON. Just think of RON. If you have expenses that are, ordinary, necessary, and reasonable, then it is like, you have an intention to create profit off of, that business that you started, then you are able to deduct those particular expenses.
Hold on.
Another thing I'm sure.
Tita, you can't write off that Louis Vuitton right there. No, I'm just kidding.
Like
Just
Louis Vuitton purse? We can't write that.
You can't write off that Louis Vuitton purse right there.
I will bring up, say that Louis Vuitton purse was actually a gift, like a business gift.
It's a gift expense for the client.
I mean, you are limited to $25 technically for a business gift.
I didn't know that.
But say,
each person.
Yeah. You got business gifts to be able to do that, or you're bringing people out to network for potentially like entertainment or something like that. There are still particular limitations on that. You got your meals and entertainment. So
and what's new about meals and entertainment for 2021 and 2022?
I believe
we can write off all of it.
Entertainment is excludable, I believe. Yes.
Yeah, sorry. But regarding the meals.
Still 50%, although for all I know, if you are a restaurant, though, it is 100%. And restaurants, even for restaurants who have, like, I guess, needed to close down, but still are able to sell food, even as a vendor, as food, and you're operating as like a restaurant, giving food for immediate consumption. If you do kind of work as a restaurant, you're still being able to kind of like deduct in full those meals, right, relative to that. But that's a separate topic.
So I thought it was 100% for 2021, like for meals. Mm-hmm. If I took someone out to eat and it was like a client, so is that 100 or 50%?
It's still, so you can take 100% if it is kind of like an office expense, if it's for the convenience of your employer, and it's almost like in the facility of where you needed them to be, and you're paying for their lunch type of stuff. Yes, it's 100.
Yeah, so pretty much, and even taking clients out for 2021 and 2022 would be 100%.
Okay, great. Yes. Okay.
Good. For 2022, we can do that too. Yes, so Eric, if I took you out for lunch, then I can write it off 100%.
Let's go, us three.
I'm down.
I'm a Cheryl.
I'm down for that. Yes. What else? And business mileage, 56 cents per mile. It's almost like the greater of your business usage miles. So I love to ask my clients, all right, well, what's your odometer at the beginning of the year? And what's your odometer at the end? And how much is like business related? And how much did you spend for your repairs, for your taxes?
Is there a difference if we have it under our business? Like if we have our car bought under our business, or
if that's under your business, now is your business on? You have created a schedule you created an LLC for it, right?
Yes.
Sorry, I think she mute. So yeah, it kind of depends on the formation too. So let's say if the asset is on your business, you kind of have different ways to deduct it. You could go by like the depreciation route, or you could go by business miles, or you could go by actual cost. So it kind of varies. So it's good that you would present all of this information with your tax preparer or accountant, and then what they would do is pretty much dissect it and see which one would be like the best case scenario for you. And then let's say once you decide to do depreciation, and then you kind of plan also, oh yeah, you know what, in year 3, 4, 5, this is what's going to happen. So I want to make sure that I think it'll be favorable if we do depreciation, or like for example, you like whatever exact cost is. So it's good to actually present all the information to your tax preparer,
And then
and at the
they'll
same time
see which
talk about
ones
your future plans
benefits
too.
me the most, right?
Yes. And then we'll kind of go, okay, dissect it. Okay, which one's more favorable? Depreciation, actual cost, or the mileage, or and so on.
It's like, how far can you go without getting me audited?
Exactly. but not really, but more on, okay, what is the right way to do it that'll be advantageous to you? What's in the
Yes.
tax laws that we could use for your advantage is what I think what we should be aiming for. And then at the same time, knowing what your future goals are, like financially, then it'll help us like better plan for it as well. Like, okay, you know what, then you're gonna be expecting, let's say, a certain income for next year, then then whatever will method will fit, then that's what will be used. But once you're depreciating it, of course you'll be depreciating until like
What
you
if I sell
reach the
it?
useful life.
Like, okay, I have my Tesla. I
Okay.
depreciate the heck out of it this year. And then the next year I get a different car. So is that going to matter? Like,
Yes, Jen, I'll let you take this one.
You gotta, so you are depreciating it, you're putting it on your books, you're reflecting it on your return. You kind of got to show your gain on loss on your sale on it. So that props now a Schedule D, gain or loss on either sale or disposal of asset. So that's going to show up on your return that you've sold it. You got some different depreciation, recapture, all that fun stuff. But now you got this new car. You want to put it on your books. You want to depreciate that. So similarly, you're going to put its cost basis on there. See what's your business usage of it. See what's kind of like more advantageous to, again, what he said, like depreciation on that, or your business mileage usage of that, and all that fun stuff.
So that's why I always present all the information to your tax preparer, and then then they could decide. And
the only thing that I personally kind of like to have as a separate deduction is is parking. Having parking as a separate business expense line item, and sometimes the repairs on that, the repairs on auto, I sometimes could include that under repairs and maintenance. Those are particular strategies that could exclude it from the calculation of what is optimal, but taking those parts of your auto in full as a deduction on your business expenses. So those are a few things.
And what do you think are the most common? Because speaking of Schedule C, like I know we have a lot of members in our group that are selling food, like food vendors, right?
Yeah.
What are things that they could, like, let's say they did get like $1,000, right? They did earn $1,000, for example. And then of course we got to make sure they deduct their food cost, right? The cost of goods sold.
Cost of goods sold.
Yeah. Cost of goods sold.
License.
Sorry, say it again.
No, she said licenses, right?
Yep, your business licenses. Your business licenses for you to do that. All your tent, your awning, your tables, your chairs are kind of like office expenses. Even just using the bank account to deposit all those things, like bank charges on your bank. You're still operating with intention to create profit. So bank charges incurred, the telephone that you needed. What I would probably do, whether you can ask them how often did you use that telephone, is very specific, or kind of like have a full for 12 months my telephone bill totaled this much. I'd like to think I used it 50% of the time, or 100% business. I'm almost always operating under a business mindset, and where am I able to kind of be able to deduct it? So telephone, your computer and internet. Sometimes I wouldn't really necessarily group like utilities, say you
separate it.
Yeah. Either utilities. The thing is, when I look at utilities, I am kind of thinking, okay, there's a space that I'm either renting out or I own, right? To be able to deduct utilities. So it's almost like, okay, if I'm paying gas, where am I going to pay gas for? It's going to be in my home, but am I using my full home, or am I going to be the business usage of that? So being able to take the business usage of your home utilities as a utilities expense, great. What else? Office supplies.
Cell phone.
Sometimes business upkeep has been a deduction as well. Kind of like you are kind of like the face of your brand, so sometimes like your own upkeep can advertisement or marketing type of things.
Abby had this question last week. The upkeep.
Like all
Oh,
your
my eyelash extensions. I don't think that applies to food vendors though.
No, it won't.
no, and the thing is too though and those are the things where kind of like percentages of your income generated. It is one of those things. Is it truly like, was it ordinary necessary? But of course, as just kind of like a face of your own brand, it is almost necessary, the things that you do. I too, I am also like a fitness instructor as well, as well as like being able to sell my own products. So like those particular aspects, my travel fees, or like sometimes my own upkeep. Don't get me wrong, like I get massages, but it's relative. It's still like to be able to work in my optimal. I'm gonna do it. If anyone's here in IRS,
So we can write off massages, because I get facial massages every week.
so so those
For
are the
stress.
things. Those are the things. Kind of like tally it up. Talk to your tax professional. A lot of those type of upkeeps, like I don't do these things often. A lot of these things are kind of just kind of like, okay, is it ordinary, necessary? Sure. Is that something that can be lumped into advertising, marketing type of expenses?
Like promotion.
Potentially. There have been particular clients who did get like a job, like like reconstruction in their body, and it was kind of like taken as a deduction. Now I don't know the effects of it because I wasn't able to kind of see the after effects of it. But taking those positions, both as the tax preparer, as well as you willingly giving that as an expense, and you chatting with them, it depends on also just kind of like the risk tolerance. Although technically, even say your clothes technically, and you are like a social media person. It should be kind of only be bought to be used once or for that event. Technically, that is write-offable. But
Good to know.
yeah, technically. Although sometimes we do have uniforms for whatever brands or whatever we're trying to do as a providing services at least. So clothes or upkeep, like sometimes laundry is almost like grouped in one like lump line item, and people kind of use this different things.
Oh, I had no idea you can put laundry in there. Wow, I'm learning something new.
Because you're
When you were talking.
And that those are the things that's almost kind of like relative to the kind of
relative,
business, right?
Yeah.
Like for me too, like part of like I have inventory in my home, but then I also run that through my S corp. So kind of like similarly being able to kind of utilize kind of like a business use of home aspect of that will still kind of run through that S corp separate from any other place that I'm renting out to a tenant. Then that's going to show up on my Schedule E. But a lot of that is its own tracing of what is business percentage kind of like usage and where is it kind of like necessary as a deduction for it.
I can see like, okay, if you had some work done, or if it increased your revenue somehow, like I guess you're more confident, or you feel more presentable, and you can show that it's increased your revenue, then
yes,
I would see how you can justify that.
Yes, absolutely. A lot of it is just kind of like really, it is just justifiable. So I mean, yeah, looking the part is very much part of the services, especially for those kind of like in real estate or in
that's what I was
even social
in
media.
Real estate, it's
real estate, social media. I wouldn't particularly say that for like other professionals, like even me as a CPA, or sometimes people in the medical field. I mean, those type of deductions, maybe not. But it kind of really depends on the presentation. Now coming back to kind of like vendors type of things, renting space out, of course, is going to be deductible. Your slot of where you're paying. your ad space on, say Facebook or whatever, all that fun stuff. That'll be kind of like advertisements. Now you got dues and subscriptions. Me personally, I'm gonna expense my Spotify because I mean I too kind of use that as a fitness instructor, and I'm gonna put that in the part of the S corp for for those services. Yeah.
I had a question for vendors. Like, what's the best way to further set up to be like when they're taxed? Should they be S corp? Should they have it as an individual, or does it depend on their how much revenue they generate?
Great question, and it's relative to all of that actually. So similar, kind of like coming back to the beginning. I personally have seen people being able to thrive on showing even up to 5 years worth of losses on a Schedule C. So without needing to incorporate that would be fine. And if you kind of feel like you don't think someone is going to be out after you seeking your assets, being able to not incorporate and therefore just filing on a Schedule C is fine. Now, of course, when you kind of think of hobby losses, is the IRS going to think like, oh no, this is just kind of like a hobby loss? That goes into a different IRS structure where it's kind of like, okay, you made $1,000, but I'm going to exclude your expenses because this is like a hobby loss that you're trying to claim type of thing. But of course, now that this is where the idea of those expenses, making sure that those are ordinary, necessary, and reasonable to create a profit, because you're coming in with the intention to create profit. And I'd like to think during COVID, despite many people being able to be creative, be both a creative as well as sell their products or sell their services, it's still almost justifiably so like, no, I am trying to create profit. I have almost either, people may have lost their jobs and had to create elsewhere, that the idea to justifiably change careers or change jobs or incorporate those is I'd like to think, I want to say like forgivable in the eyes of like paper, like sending to the IRS. It's I believe kind of like could be justifiable, I think. Yeah.
Okay,
what would
actually,
you?
no, there's just one question that popped up. It says if audited, do you need actual receipts or credit card transactions are enough as proof?
Receipts. So
If you get audited by the IRS, there you go. I put it up again.
yeah. So I mean, things are very much receipt basis. Although I have come across particular IRS audits for which, depending on what they're trying to audit, if it is going to be expenses, sometimes those bank statements could suffice depending on who would be auditing it. But of course, receipts are technically should be kept for, is it 3 years? I believe.
Yeah, that's why I tell some of my clients that doesn't like to keep receipts, so just take a photo of the receipt and then email it to yourself with the header with the subject as, okay, receipt, expense, or whatever, because I think sometimes you lose the receipts or they fade after time. At least that's a way for you to keep track of it without really doing really a lot of like the heavy work of physically keeping track of it like that. At least you have copies of it. Yeah.
You mentioned hobby earlier. I mean, how much income do you would you say is a hobby versus something that's an actual business? Because a lot of these food vendors, they started out really small and now they're making 6 figures.
So, you want to take it?
I mean, that's already kind of excluding, like you're already out of the hobby loss kind of realm already. If you already intention to create profit, but maybe in the beginning, you feel like, no, this is cool. I just want to sell, a few necklaces. I want to sell a few shirts and stuff. Even with that initial intention, as long as at the end of the day, like, hey, no, I want to actually do this thing. I want to run it. And at the end of the year, I'm like, no, full blown. Yeah, I'm ready to kind of not really particularly incorporate, but I'm ready to kind of like work on my business plan, stuff like that. On paper, I'd still be able to just go ahead, show all that income and relative expenses for it for the full year. It's just more of like, yeah, if you're making like 6 figures, heck yeah, that's gonna be
outside. That's not a hobby anymore.
It's not a hobby anymore.
Yeah, and usually they restrict the hobby in terms of like, because what people do with their hobby, they claim as a hobby. I mean, they claim their hobby as a business because the thing is they keep on like claiming a loss. That's why.
Right.
So
Yeah.
Oh,
that's the
okay.
reason why they do that. People would claim their hobby as a business because then they want to use it as a tax advantage. But the thing is, then you only get like what 3 out of 5 years, pretty much, to claim the loss. If not, then they're gonna disallow it and
Yeah.
say, it's a hobby. Too much losses for this particular
That's kind of it.
subject.
That's almost why, because similarly, like, sure, maybe in the first few years I'm like, I want to try this out, I'm gonna venture it out, and again, that's why the 3 to 5 years I'm just starting stuff out to be able to kind of like take those losses is still like being able to, on paper would be fine with, even if it's going to be at a loss. Now depending on the kind of risks of the type of write-offs for that, again, if it's justifiably so, I didn't make money my first year, but come next year, okay, maybe I made like $100 or like I made $200, but I incurred so much the prior year. You're still with the intention to make profit. I'm sure on paper I only made $100, but I spent so much on my computer, or like, you're a photographer, I bought like, some really good equipment. I would still, depreciate those assets and write off those things, because yeah, I did make my website, or I did do this, and I could write this off. And yeah, for those many years, still would be fine.
Okay. Actually, we've been running for an hour now, and I think
Ah,
that times are up. But thank you, Jennifer, for spending the hour with us and discussing taxes.
Yeah,
And
thank you so
and
much.
thank
Abby,
You're
you.
thank you.
so smart. You're
There's a
super
lot of
knowledgeable. Oh
stuff.
my goodness.
There's a lot
I
of
know
I
there
know,
is
I
a lot
knew
of stuff.
I knew we couldn't fit it into one show, honestly, because even when Eric was on our show, it was 2 episodes. And
Yeah,
that's just in relation to real estate taxes. So,
yeah. Sorry, one thing really quickly, just charitable contributions. If you are
Yes.
standard deductions, if you are going to be a standard deduction taxpayer, you're still able to deduct up to $300 on above the line,
Mm-hmm.
if you are a standard deductor. So tell them if
Make
you
donations.
in donations. Yeah, I think it's line 11 or something.
Yeah.
But yeah, if you are a standard deduction person, yeah. Um, yeah, and that's kind of it.
And that's it. Yeah. And thank you so much. And once again, Abby and Jen. Yeah. And see you guys again on the next one. And next one coming up, we're gonna Abby.
so next week, tune in for real estate. We're gonna have a real estate panel. So we're gonna have some big players in real estate. Leo Bato, I think it's Janice Jimenez, um, and also Edwin Balaloy, and Spectrum News. Joe Pimentel from Spectrum News is going to be like our moderator. He's going to ask us questions about the real estate outlook for 2022. So tune in for that. Should be pretty exciting. And with that said, Eric.
Jen? Oh yeah, and also we're gonna have Filipino Heritage Night for USC January 29. You guys
Oh,
will see it
Bruins.
in our event. You guys will see it in our events page. Please yeah, go and support. It'd be fun to do, and they have a Phil Am player there, so it'd be nice to be cheering for him. And Jennifer, what about you? Any businesses that you want to talk about? I mean, your fitness program you want to
Oh,
plug?
Oh, yeah.
well, wow, there's so many different things. Well, one, so I am accepting a lot of, tax clients, whether it's individually and or different offices that I'm working for. I do, it ranges from, middle class to even high net worth individuals. I'm very much kind of like real estate syndications. So even if you are starting like investing in those, I take a lot of those clients. I've done a full range of different kinds of individuals and businesses. So either, whether it be me, I'd love to have an interview with you. I have many resources to be able to kind of like turn those around for you and kind of maximize those things. In the fitness realm, I do teach like martial arts, kickboxing around the valley.
Wow.
Come by, support, a lot of stay healthy type of thing, and I do sell a lot of clothes, like athleisure and casual clothes. So it's called Convo Threads. Putting up my website is still always going to be in process. However, I do have inventory. But catch me online, willing to come by you and hand you all that stuff.
What are your social
Convo
media
threads?
tags?
Yeah, so Convo Threads, ConvoThreads, Convo Threads. That's going to be on, Instagram, or my martial arts one is JJoy Soto, JJoySotto. I do have another personal blog, which I kind of talk a lot about mindset and just a lot of the things art. But we could chat about that another time.
Okay. All right. Thank you guys so much again. And everyone, have a good night to the SoCal Filipinos members and Southern California Sari Store members and viewers. Thank you so much and have a good night. Bye.
Bye.
Bye.